All right, so last one of the semester. Here we go. So our assignment overview is a full valuation of Panera for a prospect KKR takeover using the driver method. We want to combine DCF trading comps and precedented trading transactions to produce an informed bid range while contrasting financial buyer discipline with strategic synergies. And then here's the snapshot of the deal, which there's a lot. $6 billion in revenue growing at 8%, $900 million EBITDA with 15% margin, $400 million net income across 2,100 stores, and digital sales are already 50%. Market references, the industry P over E is approximately 22%. Precedented EBITDA multiplies between 12 and 15 times. Chipotle trades at 35 times and McDonald's at 25 times. And capital assumptions are the industry weighted average cost of capital is 9%. Management wants a 10% rollover. Strategic bidders are Starbucks and McDonald's, and they're circling. And then growth levelers are 500 new stores in 5 years. Digital mix to 70%. Dinner/catering expansions, and then early stage of international rollout. So we wanted to create an executive summary that recommends executive ready summary recommendation that states your valuation, and there's a lot of other things that we have, but here is my output that it gave me, and this is my project breadbasket, and this is my executive summary. The deal date it gives. The recommendation is we recommend a base bid of $12.5 million, which is $26 per share, with the hard ceiling at $13.8. While the strategic buyers of Starbucks and McDonald's can justify $14.5 billion and above via operational synergies, our KKR's edge lies in our aggressive balance sheet, restructuring, executing the digital first pivot without public market scrutiny, and incentivizing management with a 10% rollover. So here's our summary. Our DCF is between $11.8 billion and $14.2 billion, which is driven by that 8% growth of margin. This is our football field, which I'll come back to later, I believe. And then the trading comps of $10.5 billion to $13 billion based on the 22 to 25 times P over E, and the 12 to 14 EBITDA. And then the precedented transactions are between $10.8 billion and $13.5 billion. Which comes from that 12 to 15 times 2. And our winning strategy for price is to open at the $12 billion to preempt auction dynamics. So start off lower to see if we can get higher. And then our signal willingness to go to $13.5 billion strictly due to due diligence confirms the catering or dinner/catering growth level is de-risked. Take that out of the equation pretty much. Our structure is the 10% management rollover is mandatory, like we said before. And then our differentiation is the position KKR as a partner for the messy work of the international expansion. So kind of fall back on them. And then, so here we go with our driver framework to, define and discover. Most of this we pretty much talked about. Our key assumptions, like we said, the $9 billion in revenue, $900 million in EBITDA, and then our 15% margin, $400 million in net incomes, WACC of 9, which is a base, sensitized plus or minus 1%. The tax rate, it's all kind of there. And then to represent, we have I built a DCF used in Python, and so that's so then to show the implementation we have here is the Python code. 1 second. So this kind of just has, this originally didn't run. I've never used NumPy Financial, I don't think. I've always just used NumPy. But so here are our assumptions like we talked about, the 6,000 in millions. The current margin, the tax rate, WACC, terminal growth, exit multiple, net debt. Here are the scenarios that we're talking about. The base scenario, growth at 8%. The upside scenario, a growth of 10%. And then the downside scenario, a growth of 4%. And this is also where the plus 1% and the minus 1% margins come into play. And there's a lot of calculations that go into it. And then it gives you the output values, which, I'm assuming it's in millions, but it's a very big number. So the base would come out to 9,722 in millions is our approximation enterprise value, and then the upside is the 11,837 in millions, and then the downside is the 7,198. So obviously there's almost $2 million difference, or $2,000 difference in between the base to the upside to the downside. But yeah, that's my results, and I can run this once to show that it comes out. I've also never seen code come out like this, just to be honest. But yeah, so that's what it is in millions. So that's my code output. And then to show this, based on the 500 new stores in the digital mix, our revenue growth, our downside case, the 4%, our base case, the 8%, the upside, the 10%, the 10%, our margins obviously decrease from the downside case, the 5 years, and our lowest, or our medium in the base case, and our highest in the upside case. The terminal growth increases from the downside up 0.5% each case. And the enterprise value on the upside would make sense that it's the highest there because it's the best case scenario. We have the highest valuation of the company and the highest enterprise value. So yeah, and then our base case enterprise value using the sensitivity analysis, WACC at 8% is 13.8 billion, WACC at 9% is 12.6, and at 10% is 11.5. And then the market valuation, the trading comparisons that we have here. Highly stable premium at 16 times, EVI TDA, high growth premium at 22, peer setting, average between 12 and 14 like we talked about before. And then our president transactions typically between 12 and 15 like we talked about. Conservative would be 10.8 billion, aggressive would be 13.5. This was our floor that we would pay, this was our ceiling that we would pay. So that's kind of what we talked about already once. This is just going back again, the football field. The floor, like I just said, is the 10.8 billion. This is supported by our president's transaction, the floor of 12 times, and the 12x, and the downside of the DCF, which I showed before. The ceiling would be 13.8 billion, supported by our upside DCF, which is, like I said, perfect execution, the best case possible, and the high-end trading comps. Our strategic zone, our premium zone is 14 billion or above, which is where Starbucks and McDonald's might bid, just because they have more money and they have more capital and they can just do more. Just to look later, the strategic bidder, the McDonald's and Starbucks, they can realize that these cost synergies, the supply chain, purchasing power, start shared tech stack, and revenue synergies and cross-selling. The quantification, assuming that these synergies equal 5% or approximately 100 million. Pro forma EBITDA is 1 billion, valuation at 15 times multiple or 15 billion capacity. The risk is that they can pay more, but they face integration risk and potential brand dilution. The financial buyer, we cannot pay for synergies we don't own, must pay based on our standalone cash flow enhancement. And then just our reflection and looking back, we cannot win a pure price war against a strategic buyer willing to pay for synergies. However, strategics are currently risk adverse regarding casual dining operational complexity. So the winning bid strategy would be opening the bid at 12.2 billion, high enough to be serious, low enough to allow negotiation. The narrative that we're trying to go off of it to see if we can actually do this takeover would be we're the only buyer willing to fund the capital investment in capital-intensive international expansion and catering overhaul without punishing quarterly earnings. And the walkaway, if the bid exceeds 13.8 billion, we pivot to credit financing for a strategic buyer rather than buying equity ownership at the risk-reward profile inverts. So we're pretty much saying that we're going to open our bidding not too low, but at a decent price, and that once it gets to a high enough point, we still want to be involved somehow, but that's just too much for us to pay, and the risk and reward doesn't really pay out for us, and we don't have enough capital or anything to do that. So that's our strategy. Thank you very much for a good semester. It was a pleasure to be in your class, and I appreciate everything so far. So have a good Christmas and have happy holidays.